Okay, let's unpack this. Welcome to this deep dive, where we're taking a close look at the recent earnings call for Gladstone Land Corporation.
Yep.
Our mission today is pretty simple. Cut through the numbers, understand the strategic moves management is making, and, figure out what it all means for you, whether you're a current shareholder, maybe considering an investment, or just curious about farmland finance.
Absolutely. It's a really interesting window into how these big macroeconomic forces, like those persistently high interest rates, directly impact things on the ground, literally in this case.
Right, for a company dealing with agricultural land.
Yeah, and we'll see how they're adapting, especially with tenant relationships and how they're structuring revenue.
So let's kick off with the headlines. First quarter of 2025, what were the key results?
Okay, so looking at the top line, net income reported was $15.1 million for the quarter.
Okay.
And digging down a bit, the net income that's actually attributable to common shareholders that came in at $9.1 million works out to about 25 cents per share.
Got it. Now, the number a lot of people watch closely. Adjusted funds from operations, AFFO. How did that look?
Right, AFFO. That came in at $2 million. Or 6 cents per share.
6 cents.
And this is where you really see a significant change. If you compare it to the first quarter of last year, Q1 2024, their AFFO then was $5.1 million, or 14 cents per share.
Wow. Okay. So that's a pretty steep drop year over year.
It's a material decrease, yeah, on that core operational metric.
And despite that drop in AFO, they kept the dividend the same, did they?
Correct. Dividends declared per share stayed put at 14 cents, same as the prior year quarter.
Okay. So core cash flow metric down significantly, but the payout is maintained. This AFFO decrease, that seems like the main story here. What exactly is driving such a big drop?
Well, the main driver isn't really like a bad quarter in the usual sense. It's mostly the result of a very deliberate strategic change in how they're structuring leases on some specific farms.
Okay.
And that's combined with some temporary issues leading to vacancies on other properties.
A strategic change in leases. Tell us more about that. What does that actually mean?
So the company has amended leases on 6 properties, and they're also direct operating 2 others. So that's 8 properties total involved in this change. Right. And what they've done is they've reduced, or in some cases, completely eliminated the fixed base cash rent. That stable income the tenant usually pays no matter what.
Hold on. Why would a landlord cut or eliminate their guaranteed income? That sounds risky, especially now.
It does seem counterintuitive, yeah. But it's really a response to the tough market conditions farmers are facing, especially out west. Think permanent crops like nuts and grapes.
Okay.
Those growers have been squeezed by lower prices for their crops and higher costs for everything, inputs, borrowing money, you name it.
So what's the trade-off then?
The trade-off is, in exchange for cutting that fixed rent, Gladstone Land is giving some cash allowances to help tenants with growing costs. And this is the key part. They've significantly increased the participation rent component.
Participation rent.
Yeah.
Crop share, basically.
Exactly. Crop share. They're essentially trading that predictable fixed rent for a much bigger piece of the action from the harvest itself. It's a way to help tenants who are struggling stay viable while giving Gladstone Land more upside if, the harvest is good and prices pick up.
Okay, so they're taking on more risk, more variability, hoping for a bigger payoff later through that crop share. How much did this actually hit the fixed rent revenue in Q1?
So because of these changes and also the vacancies we mentioned, fixed base cash rents were down by about $5.7 million compared to Q1 last year.
$5.7 million. Wow, that's a significant chunk for just one quarter. What's the forecast for the whole year then for fixed rent?
They're projecting a total year-over-year drop of roughly $17 million in fixed base rents for fiscal 2025 compared to 2024.
$17 million. That sounds huge relative to their usual AFFO.
Oh,
Is that just the rents they're not getting anymore?
Well, not quite. That $17 million number, it reflects a combination. It's the fixed base rents they would have gotten under the old deals, plus the cash allowances they're now paying out to tenants under these new amended leases.
Oh, okay. So it's double hit on that line item compared to last year.
Exactly. So you can think of it as roughly maybe $4 to $5 million less in that fixed rent category per quarter in 2025 compared to last year, which lines up with the $5.7 million we saw in Q1, considering vacancies too.
Okay. So the land is still producing, hopefully, but the revenue just shows up differently. When do they actually expect to book that crop share revenue?
And that's the absolute crucial piece to understanding that Q1 AFFO number. Most of the revenue from that participation rent, the crop share, it doesn't get recognized until the harvest is done and the crops are actually sold.
Right.
And for these Western permanent crops, that usually happens in the fourth quarter of 2025.
Q4?
Yeah. They even mentioned a smaller bit might spill over into the second half of 2026, just depending on exactly when the sales get finalized.
So what we're seeing is really a fundamental shift in the timing of revenue this year.
Precisely. Instead of fairly steady quarterly income from fixed rent, 2025 earnings, especially that AFFO figure, are going to be heavily weighted towards Q4.
Making the first 3 quarters look much lighter than usual.
Much lighter, yeah. Compared to prior years, definitely.
Okay, this is where it gets really interesting for analyzing the company, right? So the Q1 AFFO drop isn't necessarily a sign that the portfolio's underlying earning power is cratering.
Correct.
It's more a result of this deliberate decision to shift revenue recognition to help tenants and bet on the back end.
Exactly. If you just compare Q1 2025's AFFO directly to Q1 2024 without knowing this, it's pretty misleading. You really have to understand this planned deferral into Q4.
Right, you need the full year picture.
Yeah, and factor in the potential Q4 impact to get a sense of the whole year.
Okay. Beyond revenue, what about expenses? Did anything change there in Q1?
Core operating expenses did tick up a bit by about $365,000.
Okay. Why was that?
It was mainly tied to extra costs on properties that are either vacant right now or being direct operated by Gladstone or are in what's called non-accrual status.
Non-accrual status.
Yeah.
What does that mean here?
Basically, it means the property isn't generating the expected rent, usually because of tenant issues. So for these properties, vacant, direct operated, non-accrual Gladstone Land now has to pay expenses that a tenant might normally cover, like property taxes.
Makes sense.
And that increase also included some legal fees, things related to, getting new leases sorted, setting up their own farming programs where needed, and also protecting their water rights in California, which are quite valuable.
Were there any offsets? Any expenses go down?
Yes, actually. Other expenses decreased, and that was mostly driven by lower interest expense and also lower preferred dividend payments.
How come?
That's thanks to some loan repayments they've made and also some preferred shares they bought back over the past year. So less debt, less interest, fewer preferred dividends to pay.
Okay, let's zoom out a bit then. Can you give us a snapshot of the overall portfolio today beyond just these specific properties with the lease changes?
Sure. The portfolio right now stands at about 103,000 acres that's spread across 50 different farms.
Okay.
And geographically, they're quite diverse, 15 states covering 29 different growing regions. And a really key asset, especially out west, is their water holdings in California, about 55,000 acre feet.
55,000 acre feet. How much water is that?
It's roughly 18 billion gallons.
18 billion gallons. Wow. That water asset must be incredibly important, especially for those permanent crops out west that are facing market stress right now.
Oh, it's huge. Absolutely critical. Having that owned or banked water gives them vital supply security. It kind of insulates those farms from drought worries that hit other areas or force people to buy really expensive water on the spot market.
So it's a big strategic advantage.
Definitely. Enhances the long-term value and viability of those properties. And beyond water, the broader portfolio is, as I said, diverse. Over 80 different tenants growing 60 different kinds of crops, heavily weighted towards fruits, vegetables, nuts, basically, the fresh produce aisle at the grocery store.
That diversification helps when specific crops, like nuts or grapes, hit a rough patch. So given all this, what's management's current strategy on acquisitions? Are they looking to grow the portfolio?
They're still pretty cautious on new investments right now. They were very clear about that.
Because of interest rates.
Yeah, persistently high interest rates mean their cost of capital is high. And that makes buying new farms challenging. They specifically mentioned that cap rate.
Which is like the property's yield.
Exactly. The unlevered yield. Net operating income divided by value. They said cap rates on potential deals, especially for row crop farms, are often too low right now to actually justify the financing costs.
So buying land wouldn't even cover the cost of the loan needed to buy it.
Right. It would be dilutive to earnings. So given that and just general market uncertainty they mentioned, they're really prioritizing conserving cash.
Makes sense.
They expect acquisition activity to stay slow, maybe none at all, for at least the next 12 months.
Okay, let's circle back to leasing then. You said they're actively working on leases. What's the latest there, including those tenant issues?
Right. So far in 2025, they've done 7 new or amended leases. Looking ahead, they've got 16 lease schedules that expire through the rest of this year.
16 more.
Yeah. And those expiring leases, some of which also have no fixed base rent or include those cash allowances, they actually accounted for a negative $1.1 million impact on revenue just in Q1.
Okay.
So they're talking with current tenants, talking with potential new tenants for those upcoming expirations. And importantly, they're trying to shift some of these leases back to standard fixed base rent structures where they can.
Trying to get back to more predictable income.
Exactly. But they also repeated that, selling a property is always an option if they just can't get lease terms that make sense.
And what about those properties that are actually vacant or that Gladstone is operating themselves right now? How many are we talking about?
As of the call, there were 8 properties in that bucket, either vacant or direct operated.
8. Okay.
Specifically, 5 farms are currently vacant, and 3 of those are almond farms where the trees are getting old, nearing the end of their productive life.
So not much happening there.
Maintenance is pretty low, yeah. Mainly just paying property taxes. They said they're actively discussing options for all these vacant properties. That includes maybe running farming programs themselves, leasing out the water rights associated with the land, maybe planting new crops entirely, or, again, potentially just selling the properties.
Okay. Shifting gears a bit, what does all this mean for how an investor or just an observer should think about analyzing the company's results this year?
Yeah, the key takeaway for analyzing 2025 is that just comparing quarter-over-quarter results, particularly AFFO, it's really misleading right now.
Because of that timing shift.
Exactly. That revenue from the amended leases is deferred. You absolutely have to anticipate that the bulk of it will likely hit in Q4. So the first 3 quarters are going to look weaker than they might otherwise or compared to last year. It really requires patience and focusing on the potential full-year outcome, which, depends heavily on how that harvest turns out.
And liquidity seems to be a massive focus for management right now.
Absolutely. Huge priority. Cash on hand, available credit. They explicitly said they're conserving cash and putting liquidity ahead of things that might look good short term, like, say, buying back shares.
Even with the stock price being low.
Even then, they feel it's essential given the capital needed for the whole farming cycle, planting, growing, harvesting, and just the general uncertainty out there. Keeping plenty of liquidity is crucial for them right now. Avoids any potential strain.
So how does their liquidity position actually look?
Pretty solid, actually. They have access to over $180 million of capital. That includes about $40 million in actual cash on hand. Plus, they have nearly $150 million worth of unpledged properties, farms they own outright that they could borrow against or potentially sell if they really needed to raise cash.
What about their existing debt? With rates having gone up so much, is that hurting their current debt load?
That's actually a major point of strength for them right now. Over 99.9% of their borrowings are at fixed rates.
Oh, wow.
Yeah, and the average rate is really low, 3.41%. And crucially, that debt is locked in for a good while. Average duration is 3.4 years.
So they're largely shielded from the rate hikes we've seen.
Exactly. That structure has really insulated their operating results. They aren't facing big jumps in interest costs on their existing debt pile.
That provides a lot of stability. What about debt coming due soon? Any big maturities looming?
Over the next 12 months, they have about $28 million maturing. Now, about $11 million of that is individual loans tied to specific properties. They expect to refinance those, given, the underlying farmland is strong collateral. The other $17 million is just scheduled principal amortization, basically, paying down the loans as planned. That's less than 4% of their total debt, so very manageable. They also have about $7 million where the fixed rate term expires soon, but the loan itself isn't due, so the rate might adjust, but they don't have to repay the principal right away.
Okay, but the big one people talk about is that term preferred stock, the Series D.
Yeah.
That's coming up in January 2026, right? And it's like $60 million plus.
That's the one. Definitely the one to watch. Management stated their intention is to pay it off.
How?
Well, they discussed a few options, using cash they have on hand, refinancing it with banks, or maybe using money from selling some assets.
But refinancing could be expensive now.
Exactly. They noted that current bank financing costs are high. Might not be much cheaper than the step-up rate on the preferred itself.
Which is?
They confirmed that if it's not refinanced or paid off by January 2026, the coupon rate automatically steps up from whatever it is now to a perpetual 8%.
8%, okay.
Yeah. So they're exploring options, but haven't landed on a final decision just yet.
Let's circle back to the dividend again. Holding it steady at 14 cents a share per month, even with that lower near-term AFFO.
Right. They acknowledge that the current yield, given where the stock price has been, is, notably higher than the average for most REITs.
Yeah.
They're holding it at the current monthly level for now, but they did state they will reevaluate it based on the actual results of the 2025 harvest for those key crops.
So linked to that Q4 revenue recognition again.
Pretty much. Those results should be closer to Q4. So the harvest outcome is going to be a key factor in future dividend decisions.
And the stock price itself. It's been under pressure, dipped below $9 recently. What was management's take on that, especially regarding buybacks? Wouldn't buying shares back be super accretive at these levels?
They definitely acknowledge the low stock price has been, tough, but they were quite firm. Their number one priority is the long-term health of the business and, crucially, maintaining that high level of liquidity.
So stability over opportunistic buybacks.
That's the message. Even though buybacks look potentially really attractive on paper right now, they feel it's absolutely essential to conserve cash for the operational needs of farming and just navigating the current uncertainty. Liquidity trumps short-term accretion from buybacks, in their view.
Okay. Beyond the financials, any other sort of market color from the call? You mentioned the water earlier.
Yeah, they highlighted having significant banked water supplies, which is a big plus, reduces water stress worries this year for their California farms. On the crop side, they are seeing some price recovery in almonds, which is good news.
Okay.
Pistachios seem stable, but wine grapes are still soft market-wise. They also made the point again that these high interest rates are definitely impacting the whole farming sector, causing financial stress for some operators out there.
Which could mean?
Well, it could potentially create acquisition opportunities for Gladstone down the road if their own cost of capital comes down eventually. Make sellers more motivated, perhaps.
Right. So despite all these current headwinds and strategic shifts, how does management frame the long-term picture for investing in Gladstone Land?
They consistently frame it as a long-term investment, an investment in prime farmland, which is an asset class they believe has shown strong returns historically, over the long haul, even with these short-term cycles like we're seeing now in nuts and grapes.
Think into the basics.
Yeah. They really believe in the fundamental long-term trend towards people eating more healthy foods, fruits, vegetables, nuts, and they feel that supports long-term demand for the kind of high-quality farmland they own. So they're working through this current down cycle in certain areas, but seem pretty confident in the underlying asset in those big secular trends.
Okay, now buckle up. This is the part of the deep dive where we let our minds wander just a little bit, based purely on the details from this call we've just discussed.
And let us be extremely clear. This is absolutely not financial advice. Not even close.
Seriously, just some outrageous but plausible scenarios you could maybe brainstorm based on what we heard. Think of it as mental exercise only.
Please do your own research, talk to a professional. Don't trade based on podcast hypotheticals.
Okay, disclaimer delivered.
Idea
number one, a really targeted speculative trade. You're betting on a sharp upward move in the stock price, timed specifically around the late 2025 or maybe early 2026 reporting cycle.
Okay.
What's the bet?
The bet, the outrageous but plausible part, is that when that deferred Q4 2025 participation rent finally hits the books, if the harvest yields were strong and commodity prices for those specific crops happen to be favorable at that moment.
A lot of ifs.
A lot of ifs. But if they align, the reported revenue and earnings could potentially blow past current market expectations, which are probably baking in some caution. If that happens, the stock could see a sudden dramatic re-rating as the market digests that big slug of deferred income finally appearing.
Okay, so a timing play based on deferred revenue and harvest luck. Got it. Idea number two.
Idea number two, a relative value trade. Playing the common stock against that Series D preferred stock, the one maturing in January 2026.
The preferred maturity dilemma.
Exactly. Management says they intend to pay it. Refinancing looks costly, maybe according to that 8% step-up rate. So you could structure a trade around the likely outcomes.
How so?
Well, for example, if they end up using a ton of cash to pay it off, that hits liquidity available for the common. If they refinance expensively or just let it step up to 8%, that hits future earnings available to common shareholders.
Right.
So, assuming no big surprise, like a massive common stock offering to pay it off, you could potentially bet on how the market might price the common relative to the preferred as that maturity date gets closer. Depends on which way management signals they're leaning.
Yeah, the preferred should theoretically trade closer to par if payoff looks certain, while the common could react pretty significantly based on how they pay it off and what it costs.
Interesting. But again, purely hypothetical scenarios, derived only from points discussed on this call. Absolutely not recommendations. For illustration only.
Definitely. Okay, let's bring it back down to earth. The key takeaways from this Gladstone Land call really center on this planned shift in revenue timing for 2025.
Yeah, that's the big one.
They've strategically altered leases on certain farms, partly to help tenants through tough markets, but it means a big chunk of revenue gets pushed to the fourth quarter. That, plus some vacancies, is putting pressure on metrics like AFFO in the near term.
But despite those operational challenges and the market issues in some crops, management's message was loud and clear. Prioritize the balance sheet, prioritize liquidity, especially in this high-rate world.
Exactly. They're keeping their focus on the long-term value of their farmland and those underlying trends towards healthy eating.
And remember, everyone, this deep dive is purely for informational purposes. It is absolutely not financial advice. It's really essential for you to think through the implications of this revenue timing shift, management's focus on cash, when you're evaluating the company yourself.
Right.
So here's something to maybe chew on. Considering that farmland is usually seen as a long-term investment, and knowing how much things like interest rates and crop prices sway this sector, how does understanding these specific quarterly operational adjustments, these tactical moves by management, how does that shape your view on the potential risk versus reward balance of investing in this unique asset class?
Something to think about. Thanks for diving deep with us today.
We'll catch you on the next deep dive.